Hi, everyone. Welcome back. We have our next guest who is ready to tell you all about how to use and think about money in your startup, in your business. This is day 2 of the EntreGoals Summit, doing business in Nevada. We have had already 2 days of phenomenal entrepreneurs, advisors, all the folks that you want on your team to actually help you grow. And they're all based right here in the beautiful Silver State, Nevada. Once again, we have Miss Monica Coburn here. Hey, Monica, how are you?
Hey, Siobhan, I'm doing great. Thank you.
Awesome. So Monica is the CEO and Chief Success Strategist for Nevada Business Advisors. She has done amazing work within our community. Before launching her own company, she's worked as an executive for very large financial institutions, as a commercial business banker. So she knows all about how to take a small business and give them the resources that they need and grow and use financing to do that in various ways. And she's also founded Women in Business Summit. So she's been very integral in our community, empowering women, empowering entrepreneurs, and just being an all-around amazing person. Even for someone like me, when I was really just trying to figure out the basics of startups, coming down and supporting us at our Startup Weekend events and giving access to her knowledge and expertise to new entrepreneurs. So Monica, thank you for being here.
Thank you, Siobhan, and thank you for the introduction. I appreciate it. So we are going to get my screen shared here, so bear with me here. And I want to make sure that everyone can see this. So let's see. Okay, are we seeing it on the screen at all, Siobhana?
Yep, go ahead and make your presentation full screen whenever you're ready.
Okay. So as you can see, technology is not my it is not my strong suit. So let's get started here. Okay, how about that?
Perfect.
Okay, fantastic. So sorry about those few technical difficulties. As Siobhana stated, my name is Monica Coburn, and I'm going to be talking to you today about one of my favorite subject matters, which is money. And so we are going to talk about money and about financing your business. So we are going to get into the presentation, and then there will be some time for Q&A after. So just some things that I saw that I thought was fitting. And so here are some rules. Number 1 is make money. Number 2 is use that money to make more money. And number 3 is to repeat rules 1 and 2. And we've all heard the verbiage, I think, that it takes money to make money. And so I don't think it's any surprise there. We've got some innovators and disruptors that we've had throughout time. And so I wanted to share some quotes that I thought was fitting for this presentation. Obviously, we have Henry Ford. A business that makes nothing but money is poor business. So there is more to business than just money, but it certainly helps. Richard Branson, of course, we know him from the Virgin brand, and him being an adrenaline junkie and has done some amazing things throughout his lifetime and continues to do so. Never go into business purely to make money. If that's the motive, you're better off doing nothing. And we know that he's very philanthropic, and so that makes sense on that one. Rule number 1, never lose money. You know, if you're in business, never a good thing to do. Rule number 2, never forget rule number 1. Price is what you pay, value is what you get. Warren Buffett, and we all know about Warren Buffett and the investor that he is, and the multiple companies that he's put his monies and dollars into. And then last but not least is Bill Gates. Business is a money game with few rules and a lot of risk. And as entrepreneurs, as business owners, that rings very true. So we're going to get into the presentation and just want to let you know what I'm going to be covering. So first is we're going to talk about the types of financing for your business. Then where is the money? What do banks and lenders look for? How do I prepare to get funding? And when should I ask for funding? So I really took the topic of money and financing, and I really wanted to stretch that box and really give you not only my perspective as being an entrepreneur now, but having been in commercial banking and finance, and kind of going behind the screen of what bankers really look for. And so really going to be sharing some tips with you that I hope will be helpful. So financing. So I'm outlining here some different types of financing and usually what the purpose is for. So we're going to talk about business loans. Typically, when a business is looking for a business loan, it should be used for one of the following reasons. So either you are looking at buying a building for your business, you have an equipment need, so whether you're purchasing equipment, refinance of business debt, right? So if you have high interest rate loans, you can get a loan at a lower rate to refinance that business debt. Partner buyout. If you're in business with another partner, you're just not getting along, or something has happened in the business, death, divorce, whatever that might be, you're able to look at getting a loan to do that buyout of the partner. Business acquisition. So if you are looking to buy an existing business, that's when a loan would be of use. Tenant improvements. You're leasing space, so you don't own the building, but maybe you need improvements to build out that space, or you're expanding into the location next to you. So think of things like furniture, fixtures, you have a contractor coming in, flooring, painting, all of that. Buy-in. So occasionally I will talk to clients and they want to buy into a business. Not common, but it does happen, and that is something that a loan would be for. What I don't have on here is startup. If you are a startup business, startup company, you're looking to get financing, a loan would also be an option to look at. There are differences between business loans. So you have traditional and conventional loans versus SBA loans. And SBA stands for Small Business Administration. And that is a government guaranteed loan. And there are some clear differences between the two. And I'm just going to give you a high level overview. With an SBA loan, there's more flexibility with this loan product. And what do I mean by that? That means typically you have a longer term, the interest rate may be a little bit higher, but it's still favorable. The fees are going to be a little bit more, but the biggest advantage is really the flexibility that the program offers. So for example, if you were a startup business, it would be very, very, very difficult to walk into a bank and get a traditional loan that was not SBA. And the reason for that is it's a startup. There's no history behind it. With SBA, there is some flexibility with that. So that's just one example. The other type of financing is lines of credit. And sometimes with businesses, they say, well, I need a loan. And when I talk to a client or a business owner and I find out what do you need the money for, it's really a line of credit that they need versus a loan. And so what do I mean? Working capital. So if you're needing funds to hire people, add people to your team, you need marketing dollars, you need advertising. These are all intangible things. Whereas with a loan, it's typically fixed assets that you would get a loan for. So I'm going to head over to the next slide, and I don't know what's happening, but this should say alternative financing. And we've got some alternative characters and letters that are showing up, so we're going to play with it. So some options for alternative financing is what I call the F word. That's just my humor kicking in, and it's called factoring. And so there's some connotation to the factoring financing as really being kind of a financing that you don't want to really deal with for a number of reasons. You're typically paying more. Um, there's other reasons where if you use this type of financing, it's usually bringing in a company that does this financing. And when your billings are sent out, that money that's being sent back in does not go to you as the business. It actually goes to this factoring lender. We're not going to get too much into the weeds on this, but this type of financing is actually very common for certain types of businesses. So staffing companies, for example, if you're in the textile industry, so a lot of fashion houses, designers, they may use this type of financing. Um, Large manufacturers. So it really depends on the industry and what you're doing. This could be a great method for financing. One of its advantages is you get your money much quicker than if you needed to go down traditional financing. There's also government sponsored programs. And so an example that I'm going to talk about is NOF, which is Nevada Opportunity Fund. This is a state of Nevada program that is administered by one of the regional banks here locally. And basically, it's a pool of funds that the state has said, we're going to allocate these funds to our small businesses who may not be able to get traditional financing. They may not even be able to get SBA financing. So we're setting this fund aside and we're going to use this as a pool of funds to help these businesses. Then you have micro lenders. So micro lenders are companies like Axion, which you may not have heard of. They are a nonprofit lender. So they do typically very small dollar amounts, 5,000, 10,000. These are amounts that would be considered too small for the banking industry. Then we have other financing. So family and friends, some people will take equity out of their home. I've seen businesses fund their business with personal credit cards, seller financing. So this is specific to if you are looking to purchase an existing business and the seller was willing to finance that business and actually carry the note, then you would be making payments to the seller directly. So that is an option. It depends on the seller. Crowdfunding. This is still a very viable option, but usually there has to be a purpose behind it. So Indiegogo, Kickstarter, those are campaigns. Investors, right? Private equity, angel investors. You may have private investors that are just an individual and they want to be investing in your business, but they may not be a family member, right? It could be someone that is in your contact list. MCAs. This, unfortunately, and again, this is the opinion of Monica Coburn, stands for merchant cash advances. And it's becoming a very dangerous tool, in my opinion, of businesses having to utilize this form of financing. And so what this means is a business who accepts credit card as payment, right? So think of a retail store, a restaurant, any company that takes credit cards can use this as a financing option. So there are companies out there that basically will take a percentage of those credit card sales on a daily basis. And it's basically giving you money up front, but at the end of the day, they're taking a percentage of those sales. And so I say avoid if at all possible, because you're losing your profitability, you're losing revenue, you're losing income. But if it comes down to where you're really needing this daily cash flow, this is where businesses are utilizing utilizing this method, and quite frankly, a lot of them are getting into trouble because it's a vicious cycle that they can't get out of unless you're able to refinance this debt. So this is something that I put on here, just a quote by Bob Hope: "A bank is a place that will lend you money if you can prove that you don't need it." And there's a banker's joke that the banker is there with the umbrella when it's sunny, but when it's raining, they pull it away. So a couple notes here. Very important as a business owner, as an entrepreneur, that you get a great banker. Number 2 rule is make sure it's the right banker. It's not necessarily the banker that you see when you walk into your bank, right? They may not be the right person. They may be great to you, they may be friendly, but they may not be the right person that you need to talk to about your business. So this is very important, to form a relationship with a business banker. And if you are not sure that the person you're dealing with now is the right person, then ask the question next time: do you only work with businesses, or do you both business and personal, right? Very important you work with someone that knows how to work with small business. So we're going to talk next about where is the money. So the big ones are banks, of course. There are some credit unions that do financing for business. There are non-bank lenders, and what I'm going to give you an example. I don't think they do it to a certain degree with GE Capital, right? They're not necessarily a bank, but they would be considered a non-bank lender. And then, of course, private equity. Now, I know we're targeting businesses that are $1 million and under in revenue, and usually your private equity firms are going for companies that are in growth mode, they're expansion mode. But I've seen a shift that private equity firms are looking at a lot of different opportunities. So you don't want to cut them out completely just because you make under $1 million. Do I feel it's the best option to pursue? Probably not, because you're going to have to give up, right, ownership of your company. Now here's where my banker notes come in, because I'm going to cover with you next, what do banks and lenders look for? And we're going to talk about what I call the 5 C's of credit. And so we're going to start with number 1, which is character. When you're applying for a loan or a line of credit, anything for your business, one of the first things that's going to be done by a banker or bank is they are going to pull your credit report. And your credit character speaks to your overall trustworthiness as a borrower. Fair or not fair, depending what your point of view is on this, right? But as the banker, as the bank, they're looking for, are you paying everything on time? Are you late? Your credit score and your credit history play very important roles. Now, do you have to have perfect credit? Not necessarily. Depending on the bank will depend on the flexibility. So if you've had a bankruptcy, much more difficult. If you've had a foreclosure, more difficult. Collection, maybe there has to be a story, right? And what is the explanation behind it? If it's medical related, from my experience, banks tend to be more flexible if you can explain what's happened. If you've got a couple late payments, okay, what's the story? But the banks are looking for a pattern, right? And so if you're asking for the bank to lend you money, in the banker's mind, they're going to ask themselves, what's the likelihood of this person paying us money back if personally they cannot pay their personal debt back? Okay. Additional due diligence sometimes is done by a lender, so they're going to look to vendors, suppliers, your business license status, right? They want to make sure that you have an active license, it hasn't been revoked, you're not making things up, and sometimes criminal history. So for as example, SBA loans, that is one of the questions it will ask is, have you been convicted? Have you been arrested? Does that make you not eligible completely? Not necessarily. But if you've been convicted of bank robbery, it's probably not going to happen, okay? But I did want to add that in there. Number 2 is capacity. So capacity can be also referred to as cash flow. How well can you manage your current and your projected payments? Banks or lenders will look at your income, right? Is the business making money or is the business losing money? As an individual, they're going to look at personal returns. They're going to look at your business financials and a combination. Now, if you're a startup, you obviously are not going to have business financials. So a lot of the weight is going to be put on you personally, right? What has your history been with your earning ability? What does your personal credit look like? It comes into play even more so. The stability of your income. Is your business seasonal? What do the financials look like? If the lender looks at your financials and they see you're driving a Rolls Royce, you've got a multi-million-dollar house, and the business is losing money, oh yeah, and by the way, and you're taking $500,000 every year in salary, they're not going to be comfortable with that, right? Because they're now seeing you're funding your personal lifestyle and you're not putting money back into the business. So very important. The last one is ratios. I'm not going to get into ratios because there's multiple ratios that a bank or lender will look at. So I'm picking on the number 1 to be aware of, and that is called the debt to income ratio. The minimum ratio that a bank or lender is going to look at is 125 to 1, and I'm going to break it down very simply. The bank is going to see if you make $1.25, can you at least pay us back $1? That's the simplest explanation I can give you. And there are other ratios, but again, for time purposes, we're not going to talk about that. So that's capacity. Next is collateral. So collateral is the security blanket, as I like to call it, for the bank or lender. Collateral are assets that can be sold and used as a backup source of repayment. At the end of the day, the bank is lending on risk, right? Because they have shareholders, they have investors, and they want to know how are they going to get paid back their money. So it's always that worst case scenario. If we lend $100,000 to this business, if that business doesn't make it and if that business goes under, how are we going to get paid, right? And so this is where they look at what kind of equipment does this business have? Do they own a building, right? Do they have any assets that we can take? So they're going to look, we need to liquidate things. And this is where this comes into play. And the example that I use is if you had a mortgage on a house, right? The bank would take your house as collateral. They would file a lien or a deed of trust on the house because that's their security blanket. They want to make sure they're going to get those mortgage payments. And we all know it happened about 10 years ago when the market went like this, right? A lot of foreclosures. So that's the mindset. Other examples of collateral: cash in the bank, inventory, equipment, real estate, accounts receivable. At the end of the day, the bank doesn't want to be a landlord. They don't want to go and take your collateral back. They want you to pay the money back. That's how they make their money. When it gets to this situation, it's the situation, frankly, they don't want to be in, but they will go and recoup as much as they can. And that's why collateral is really important. Next is capital. So if you're coming to the bank and you're looking for financing, they want to know how much skin do you have in the game. So I'm going to pick on a startup. If you're a startup business, you have no history, and you're asking for $100,000, if you're expecting the bank to lend you $100,000, not going to happen, because they're going to require you to come in with some of your own money. Every bank is different, so there's certain percentages. Some banks may say, we need 30% for you to come in with before we'll even consider giving you $100,000. Other banks may say, we need 50%, and other banks may say, no way to a startup. So it really depends. If you're looking at buying a building, you'll need to come in with some down payment, just like you would on a house, right? Do you have cash in the bank? Do you have a financial reserve or cushion, right? If you were to make a down payment and put in an injection on the loan, but at the end of the day, your bank account gets zeroed out, the bank's not going to be comfortable with that. So they want to see that you've got some reserves, right, for a rainy day. If anything were to happen, would you have something to fall back on? At the bottom line, the lender or the bank wants to see that you're invested in your business as much as they're looking to invest in you. Number 5, conditions. So these are things that really are intangible. These are the what ifs, right? The unknown. So what does the economy look like? What does the industry look like? And I'm going to pick on the taxi industry, right? Because we all know what's happening in the taxi industry with Uber and Lyft coming on board. They have disrupted the industry. And so if you are a taxi company, it's probably going to be more challenging to expand your fleet of vehicles unless you're long established, you've got great cash flow, and you meet all these criteria. It's more challenging because there's been disruptors in the industry. Stability, right? What's the stability of your industry? Look at retail and what's happening with retail, right? A lot of people are moving and shifting to online, and that's been continuing. Trends, and the bank will look at how the money will be used. So they're always going to want to ask you, how are you using the money? I'm going to go through this very quickly because we're running out of time. How do you prepare to get funding? Quick. So you got the mouse heading with the cheese, with the helmet. The mouse is ready to get that cheese, right? By failing to prepare, you are preparing to fail. So these are some things to consider. Started versus existing. Make sure you follow those 5 C's of credit we went over. They're going to look at your personal credit. You must have a business plan and projections when you're a startup. The bank wants to see, what are you projecting your business to make? What do you project your expenses to be? What kind of down payment do you have? What kind of collateral do you have? Existing business, same thing. They're going to look at the C's of credit. They're going to look at your personal credit. And then, of course, what are you using the money for? Equipment, real estate, what's your growth plans? When should you ask for money? It's never too early to start having a conversation with your bank. Even if it's 6 months from now, a year from now, it could be 3 years from now that you say, you know what, I'm looking at expanding in Florida. The sooner you have that conversation, the better it's going to be. Make sure your financial house is in order, right? Your personal credit, you've got cash in the bank. Know what to ask for before you talk with your banker and be prepared, right? Never say, what can I qualify for, or how much money can you give me? Now, the banker may not do what Adam Sandler is doing in this picture, but that was my way of saying you just don't want to go in there and do that, because that shows you haven't researched, you haven't done your preparation. This just gives you just a quick short list of some of the documentation that a bank would look for. It's my contact information. If there's any questions after my web address, nevadabusinessadvisors.com, that is my email address.